This is episode 4 of how to master your entry and exit levels. In this episode, we are focusing on fundamental analysis. Yes, the bigger forces that move the currency markets. While technical analysis helps identify potential entry and exit points, fundamental analysis allows us to understand the why behind price movements. So let's look at some key economic indicators. Right now, on the first on the list actually is GDP. Now, gross domestic product. Trust me, many a time we are more focused on the technical analysis as we move on to the chart. But whatever happens on the chart is being controlled massively by what we call the fundamental analysis. So you have an upper hand and full understanding of the fundamental analysis can actually help you trade well on the technical analysis or on the charts. In fact, these two terms go hand in hand. You cannot do away with the other. Some also say they are fully technical analysis. Some also say they are fully fundamental analysis. But trust me, the two must go hand in hand if you want to become a varied market analyst or a trader. So back to what GDP is. GDP is essentially the total value of goods and services produced by a country. It is a key indicator of economic health. A country with a growing GDP is often seen as strong, which strengthens its currency. For example, if the USA posts higher than expected GDP growth, the USD, usually gains more value against other currencies because it signals a healthy economy. Right. So, in fact, I will also teach you on how to read, at least introduce you to fundamental analysis or how to read news. Right. So, we will look at this on the site called my FS book. That is where I read most of my news or the news event, the calendar. So if you understand this, you can actually go hand in hand. So remember, whenever I'm doing this weekly analysis, I tell you that in the course of the week, I'll have to confirm whatever I see on the technical analysis or on the charts with the fundamentals. If they go hand in hand or there's an agreement between the two, then I'll have the full confidence to enter the market. So you see, for you to actually enter a market, there are a lot of work, some background checks that you have to do before entering into the market. Now, the second thing is inflation. I know this is very common, a buzzword actually. Now, inflation is the rate at which the general level of prices for goods and services rises. I know you have idea about this. Now, central banks like the Federal Reserve. So in a country like mine, in Ghana, the central bank is actually the BOG, that's Bank of Ghana. Yes, so in every country they have their central bank. That is it. Now, reserve manage inflation by inflation is the rate at which the general level of prices for goods and services rises. Central banks like the Federal Reserve, manage inflation by adjusting interest rates. So basically, one of their key tasks as a central bank is to manage interest rates, manage inflation and all that. That is their basic work that they do. If you don't know, I'm telling you today. Now, higher inflation typically leads to higher interest rates. Once again, higher inflation, typically leads to higher interest rates, which increases demand for that currency because investors want to take advantage of the higher yields. So, if inflation in the eurozone rises, for example, we might expect the ECB, that's the European Central Bank, ECB, the European Central Bank, to raise rates, and the euro could strengthen. Right, I'm going to take this in again. So, for example, higher inflation typically that's what leads to higher interest rates, which increases demand for that currency because investors want to take advantage of the higher yields. So if inflation, for example, in the Eurozone rises, right, we might expect the ECB to raise rates and the euro could strengthen, right? So that is it. If you want to understand it, you can pause the video and listen to this once again. Now, the next thing is interest rates, which we had a glimpse into that. Now, interest rates set by central banks are probably the most important fundamental driver, right? Driver. Now, higher interest rates tend to attract foreign investment, leading to a stronger currency. For example, if the Fed, right, the Fed, that's an American organization, that's what they do, it's part of the economy, they control this. When you read my FS book, the news event and all that, you understand what is the Fed, right? So if the Fed raises interest rates, right, foreign investors flock to what? To US bonds, sorry. They flock to what? US bonds, which increases demand for the dollar. Conversely, if a country cuts rates, they cut it, as in you understand, when they cut it, its currency usually weakens. So usually it weakens, it becomes weak. Now the next thing is what? Employment data. Now employment data is another key economic indicator. Data like the US non-farm payrolls, those who, in fact, if you have been trading for a long time, you know what is a non-farm payroll. Their impact is very, very high. And then when they happen, when there is a news on this, it can actually make the market go haywire. So that's what we're talking about. So employment is another key economic indicator. Data like the US non-farm payrolls, that's NFP, you understand, report can significantly impact the market. Strong employment numbers suggest a healthy economy, leading to a potential interest rate hikes, which strengthens what? The currency. Right. On the flip side, weak employment data could indicate a slowing economy, weakening what? The currency. So now let's see the impact of news and geopolitical what do you call it? Geopolitical events. Now, news and political events can have immediate effect on currencies. Think about the Brexit situation. Every update caused massive volatility in the British pound. When the UK voted to leave the EU, actually the pound plummeted, as in it started selling massively because traders feared long-term economic instability. Geopolitical tensions, natural disasters, or trade wars can create opportunities for traders who know how to react to the news. So if you have been trading, yes, whether intermediate or a beginner, normally you hear that there's a war again between the Israelites, right, and against maybe other countries. You know, I think some happened between the Ukraine and Israelis or so. I think I've forgotten. You see, that war, when it happened, in fact, the market was very, very rosy, especially on gold. You understand? So many a time people make profits in times of these adversaries. I don't know. So one thing about forex is that in either ways you can be profitable. Whether the market is being buying, rallying, you can enjoy from that side. When it's selling, you can also enjoy from that side. It's just based on how you can actually make use of this. So you understand what the forex is. So when actually in the real world things are happening bad, financially people are enjoying. So that is one downside of what? The market. I can't even call it one downside. So that is for that. So now one of the tools you can use for this is an economic calendar. Like we said, we know how to read. If you don't know how to read, it's also a problem, which helps you track important events like central bank meetings, elections, or major policy changes. Always be aware of upcoming news when planning your trades. This is very important. So I do that in our weekly FS forecast. If you are new to the channel, you might want to subscribe to that playlist. You can watch all of them I have actually what? I do the analysis whilst I open your eye to other important what things. So now let's move to the next thing called market sentiment. Right? You may have heard this. Besides the fundamental, we also have the technical, and then we have the market sentiment. This is a reaction from the traders. Actually, it has nothing to do with anything like fundamental or technical, but we can still put all of them together. Now let's talk about the market sentiment. Now sometimes even when all the fundamentals look good, market sentiment can drive prices in the opposite direction. This happens when the overall mood or feeling of the market doesn't match the economic calendar or data. You understand? So when the technical is not working, this is not working, sometimes the sentiment has some power. So if investors are worried about a potential recession, they may sell off. They may sell off riskier currencies like the Australian dollar, even if Australia's economy is performing well. So it's a reaction from the traders, and it can happen because we are trading the market actually. So that is it. Now, one way to gauge market sentiment is by looking at the commitment of what traders. That's we call it COT. Right? It's a report. It's a very important tool that if you become very varied in the trading, you should, or in fact you will understand. This is used by or reported by the big industries like the banks, the financial industry, the bigger ones, the hedge funds and all that. They give this report. I think every 2 weeks, in fact every week, they give that report before on the trades that you have actually put in pending. So that is what it's all about. You can read more about this. Now this report shows whether the large institutional traders are buying or selling a particular currency. I told you. Now, if large funds are buying, right, it's a sign that sentiment is bullish. You can use this in conjunction with the fundamental analysis to get a clearer picture of the market. Now, applying fundamental analysis. Let's walk through an example of how you might use fundamental analysis in your trading. Imagine the European Central Bank, that's the ECB, is expected to raise interest rates because of rising inflation. As a trader, you might decide to buy the euro against the USD in an anticipation of the rate hike. But you also want to look at the technical side, checking for a bullish trend before you enter the market or the trade. Now, once the news hits and the ECB raises rates, the euro strengthens and you exit the trade at your target profits. Right? So you can play the video back, relax and listen to this. I'm managing the time here. You can see how combining technical and fundamental analysis can give you a more complete picture. Right. So in fact, that wraps up our look at fundamental analysis. It helps you understand why the market moves and gives you confidence in your trades. In the next episode, we will pull everything together to help you create a personalized trading plan that works for you. Right. So see you in the next episode. Bye for now.